Alrighty, greetings everyone and welcome back. My name is Chris. I am here back again, ready to rock and roll with everyone and go through another wonderful webinar with you. Hopefully everybody had a beautiful day in the markets today. It is Monday the 2nd, 2018 of April. We're going to go ahead and get started here. Today, guys, we're going to be covering Bollinger Bands, but before we go any further, you guys know the drill. I'm going to go ahead and throw some disclaimers on screen. I'll read through the first one. The ones thereafter, I'll just leave on screen and let you guys screen capture them or read them yourself, and then we'll be on our way. So here we go. So starting off with our disclosure, folks. Earn to Trade is provided to you for educational purposes only. Earn to Trade is not a financial services company. Earn to Trade does not accept any liability for loss or damage as a result of the reliance on the information contained herein. This includes educational material, price quotes, and charts and analysis. Please be aware of the risks associated with trading the financial markets. Never invest more money than you can risk losing. The risks involved in trading are high and may not be suitable for all investors. Earn to Trade doesn't retain responsibility for any trading losses you might face as a result of using the data shown on its websites or webinars. The data and quotes contained may not be provided by exchanges, but rather by market makers. So prices may be different from exchange prices and may not be accurate to real-time trading prices. Any examples used are not a recommendation to buy or sell or a solicitation to buy or sell futures, options, bonds, or binaries or securities of any kind. The information and strategies and techniques discussed herein are the property of Earn to Trade LLC. They may not be shared or distributed to another party without the express written consent of Earn to Trade LLC. Any trademarks or copyrights referenced other than the Earn to Trade are the property of the respective holders and not Earn to Trade LLC. Going to switch on over to the other disclaimers, folks. Please read through them carefully or screenshot them and read them later, and we will be on our way. And moving along to the next one. And keeping it flowing, moving along still. All right, and one more. Wonderful. Okay, like I said, so today's webinar is going to be focused on Bollinger Bands. But before we go into that, I'm gonna, introduce myself to those of you that don't know me. Obviously, most of you do, and have heard my voice before as part of the daily recap, as I do the daily recap as well as operate these webinars weekly. My name is Chris. Like I said earlier, I am a mentor and educator here and trader at Earn to Trade. And like I said, I do operate the webinars and the daily recaps as well as a few other things on the site. So a lot of you probably are already familiar with my voice. So hopefully my buttery smooth, I'm just kidding, guys. I'm not going to go any further into that one. But we're going to go ahead and get started, guys. We're going to talk about Bollinger Bands today. Bollinger Bands What are they? How can they be used? And how can they potentially impact your trading in a positive way? The goal of the webinar is quite simple. We want to continue expanding our knowledge of trading and learn about Bollinger Bands on live charts while simultaneously showing you how to use this indicator in real time. After the webinar, you should be able to begin applying and using Bollinger Bands on your personal charts by yourself quickly and easily. So what we're going to go ahead and do now, folks, is I'm going to switch on over to my screen share of my charts, and we're going to go ahead and get this interactive. If you have any questions along the way, please feel free to ask them. Don't worry about interrupting me. You're not gonna offend me. You're not gonna make me angry. It's kind of hard to do that, so we'll be okay. Ask any question as it comes up. If you have any questions, I have no problem stopping and answering the questions at the time. I might possibly go past it if I am in the flow and I want to come back and answer the question a little bit later on. But if you don't feel like there's anything confusing going on, then you don't have to ask any questions at all. It's not a requirement. Sit back, relax, enjoy the show. Just because you don't ask doesn't mean you're not having a good time. And if anything, I take it when somebody isn't asking any questions, I generally feel that I'm doing a pretty good job and you guys are having your questions answered before you have to ask them. So just like I said, guys, feel comfortable asking. Let's keep it nice. Let's keep it fun. Let's keep it casual. You're generally the most conducive. A fun learning environment is generally the most conducive to a efficient learning environment. But let's see what we've got here. Richard says, your audio keeps cutting out. Is it just me? He said, I think sometimes it may be Google. I tried Safari last time and it worked. Jim, do you mind giving me a secondary check here? I see that you're typing as well. Can you hear me okay? My levels look like they're broadcasting fine. I've got a strong connection at the moment. There shouldn't be any issues. Richard says, just swap to Firefox, working okay now. All right, perfect. Yeah, so it might have just been a simple browser issue on his end, so no issues. Sounds good. Wonderful. So switching on over to the screen share, folks. Here we are. All right, so what are Bollinger Bands? Let's go ahead and start with that before we go down into the nitty-gritty, before we start getting too technical in all of this and actually applying them. Let's talk about what they are so you can have a little bit more of a broader understanding of it before we, it's important to understand what it is we're using before we learn how to use it, right? Bollinger Bands were developed by the famous technical trader John Bollinger, hence the name Bollinger Band. Bollinger Bands are a plotted area, two standard deviations away from a simple moving average. Okay, I'll repeat that one more time. Bollinger Bands are simply a plotted area with two standard deviations away from one simple moving average. Bollinger Bands are a highly popular technical analysis technique. Many traders believe the closer price moves to the upper band, the more overbought the market, and the closer price moves to the lower band, the more oversold the market. So a relatively simple concept, right? We have a simple moving average running through the middle, as you can see here outlined by the white line. And then we have two deviations separating us and giving us an outside, an upper, and a lower band. And like I said, many traders believe when price moves closer to the upper band, we have an overbought market. And as price moves closer to the lower band, we have an oversold market. So simple idea, simple concept rather, moving forward. So Bollinger Bands can be utilized in any market condition as they adjust based on the deviation that I was just mentioning. That's what makes this quite useful. So it's the first thing that I like to talk about when I start these webinars is, where can this be used? What is it, and where can it be used, and how important is it to me? That way you can gauge it yourself. But the beautiful thing about Bollinger Bands is a lot like the other things that we have covered is they can be used in essentially any market conditions because they are based on that deviation. Because standard deviation in and of itself is a measure of volatility, the bands simply become wider during more volatile conditions, and then during less volatile periods, the bands contract. It's that simple. So remember, more volatile conditions, the bands become wider. Less volatile conditions, the bands contract. They become smaller. All right. So generally speaking, in a more active market, you've got wider bands. In a little bit of a slower market, you tend to see smaller bands. Okay. You tend to see tighter bands. So what we have on screen, like I already said, is we've got an example of the Bollinger Band. If you don't know how to apply these to your charts, I'm going to show you how to do it on our platform. Now, if you are operating a different platform, you're using a different, different price feed of sorts, you're not going to most likely have the same methodology of applying these to your charts as I'm doing here. But once again, if you're using our proprietary trading platform, this is going to be real easy to follow along with. We're simply going to go down to the bottom left, where we're going to click on our little chart icon below the pen icon, how we add all of our indicators. And I'm going to go ahead and delete the Bollinger Bands so I can start fresh. So once again, going down to the bottom left, I had deleted the Bollinger Bands, clicking on the little chart icon, and then we're going to be given this more opaque view with a few options on the top left under section 1. Now, we're simply going to go over here and click Add Indicator. Bink. Now, once we've done that, it's going to say blank. It says blank because we haven't actually told it what indicator we want to add yet. And this is going to be a direct overlay of price, as we haven't added a separate individual section like we did in our previous webinar. So I'm going to click on blank, and then I'm going to scroll down to what I want. In this case, Bollinger Bands is at the very top, so I'm going to click on Bollinger Bands. After doing that, I'm going to come down to the bottom center of this chart, and I'm going to just simply click Close. All that opaque mess goes away, and we are left with some beautiful Bollinger Bands on our charts like we saw in the beginning. I just wanted to go through that process just in case some of you aren't too familiar with how to apply them. But now that we have them on our charts, we can see our simple moving average moving through price, and then we can see our outer and our lower bands. Now, my upper band is illustrated by a red line in this case, and obviously, guys, these colors are entirely customizable. You can change the colors just like you can change your candlestick colors to any color you want. So if you don't say you don't like red up on the top end or blue on the bottom end or what have you, fear not, all of these colors are changeable. Don't worry. But anywho, so we have our simple moving average moving through price. We have our upper band, which is illustrated as a red line above price, and we have our blue band below price moving along as well. So I'm going to go ahead and find some examples here. I'm going to find some examples of going back to more or less what I was talking about earlier when I was giving you a little bit of a backstory on what Bollinger Bands are. We said in more volatile markets, the bands are wider. And during less volatile markets, the bands are smaller. So we're going to start at the beginning like we did. First things first, let's go ahead and see what a wider band looks like versus a smaller band, meaning more volatile conditions and less volatile conditions. If we immediately just look to the right, we can see a period right here. I want to draw this off in a nice little box for us here. If we focus right here, we have a period where the volatility picked up quite extensively, and as a result, the bands went bananas. We had a situation in which the bands started working their way up quite steeply, and at the same time, the bottom band also started working its way down quite steeply. This is an example of the bands getting wider due to increased volatility. So once again, this is what volatility is doing to our bands. This is the effect that volatility has on our bands. This is the effect that extra market activity has on our bands. You can see that the market started picking up here. We have some larger candles, some heavy spikes, and some heavy momentum driving the market downward. Anywho, we have our simple moving average still working through price, the white line obviously all the way, splitting the difference. But now let's go ahead and look back just a little bit. And if we look over here, to the left, you're going to see an example of when the market is a little bit less volatile and the bands are quite a lot tighter. So over here, we've got a situation in which the bands are spreading, a very, very large distance from top band to bottom band. Now over here, where the volatility is a little bit less, the market's moving a little bit slower, don't have as much activity going on, we have a situation in which these bands have become very, very tight. These bands are I mean, if you can't tell the difference between how tight these bands are to how tight the bands are on the right, I don't know what to say. You might need to visit the eye doctor before we continue with this webinar, but you'll see an example here, like I said, on the left of tighter bands, and this is an indication that the volatility is quite a lot lower. As the market starts to deviate less and less, the bands tighten in. As the market starts to deviate farther outwards, the bands open up. This is how they fluctuate. I'm going to keep moving backward and show a couple more examples of that before we move on to our next point. Let's see what we've got here. All right, here's another two great examples of this. So, anywho. If we take a look over here to the right, we have this beautiful formation that almost looks like a pair of lips. We've got our upper band bending upwards quite quite heavily, then coming back downwards, tightening up a little bit as the volatility got a little bit slower over here, and then started expanding outwards again as it began to pick up, and the same thing happened on the bottom. Obviously, it looks like a mirror image because in and of itself, it is. So we've got a situation here where, once again, extreme volatility has caused the bands to widen. But if we look to the left, we have a period of we have a period of lower, not smaller, we have a period of lower volatility, less action in the market, and as a result, the bands are tighter. Very simple concept, but it is important to understand. Once you understand how the bands work, we can then begin working into how we can actually use them to start executing trades based on them or with the help of them. We've got a couple questions in chat. Let me see what we've got going on here. Let's see. We got, if the upper and lower bands are just deviations, then why do the bands seem to have moves that the moving average doesn't? If the upper and lower bands are just deviations, then why do the bands seem to have moves that the moving average doesn't? Because the simple moving average is simply a moving average in and of itself. It's going to split the difference, whereas the deviations of them two are just that. I'm trying to think of a correct way to word this. I'll probably come back to that and give you a more articulate and more intelligent response as we work our way when I think of a better way to word that. It's not coming to my mind right now. Let's see. And why doesn't the top movement match the bottom movement? The top movement does not have to match the bottom movement, but they are essentially a mirror image of themselves. They don't match the bottom movement because price is moving above and below that simple moving average in the middle, and as a result, the deviations of price between that moving average are different. But anywho, moving backwards, we're going to look for one more set of examples here where bands are getting tighter and smaller, and then we're going to work into how they can actually be applied to our daily trading and the good stuff, the stuff that you guys are interested in. How can this benefit me? That's what everyone wants. How can it benefit me? So moving backwards. Here's another good example. We'll take this one right here. So we're going to start off by outlining this area. Once again, volatility decreased. As a result, the bands got tighter. Tight bands, lower volatility, less action happening in the market. Easiest way to think of that. We look a little bit to the left. We have a period of higher volatility, and the bands are quite a lot wider, quite a lot farther apart. Once again, more volatility, bands widen. Less volatility, bands tighten. It's the easiest thing in the world to remember. All right. So essentially, there is a popular term that I should have mentioned that I'm going to go ahead and run into now. When the bands come close together, like this example here that we were just talking about, when the bands become close together, constricting the moving average, it's called a squeeze. A squeeze, like I was saying earlier, it's just a fun term to signal that period of low volatility. It's considered by traders to be a potential sign of future increased volatility. That's the importance of understanding the differences between these wide bands and these small bands. Once again, a squeeze is just the correct term when we refer to these Bollinger Bands becoming tighter. And once again, many traders believe that a squeeze is an indication of future increased volatility, as the market is always dynamic, it's always changing. If it's currently slow, they don't expect it to stay slow forever. That's the logic behind that anyhow. And then conversely, if we go back to looking at a wide example, let's talk about that real quick. Right here. So we're going to outline this wide example to the left. So when we're looking at a higher volatility window when the bands are a little bit farther apart, traders generally view wide Bollinger Bands more likely with an expectation that there's going to be a decrease in volatility and a greater possibility of exiting a trade, so to speak. So when the bands are really, really far apart, traders generally are viewing this as, hey, we don't expect it to last very long. We expect this to be happening soon, and we might want to consider finding an exit place for our position. Now, how you interpret it is going to be entirely up to your personal preference, of course, but I am just going to tell you what the general consensus is. I'm going to provide you the information, and then what you do with it, obviously, after that is entirely up to you. But it's important to understand that with these bands being wider and smaller, all the while, it's important to understand, though, that 90% of all price action occurs between those two bands. 90%. 90% of all price action occurs between the two bands. right? If we have 90% of all price action occurring between the two bands, some of your cogwheels are probably already turning, getting ahead of me here, thinking about what you could do when price is beyond those bands, if most of the time we're expecting price to be inside those bands, but we're going to get to that. But anywho, a breakout above or below the bands, which is what we're going to refer to as this right here. A breakout above or below the bands is simply going to be when price has moved outside of the bands, meaning it has moved outside the upper band when the market is considered to be overbought, or it has moved outside the lower band when the market is generally considered to be oversold, which would also be right here. So we have situations in which price moves outside these bands, but for the most part, 90% of the time, we're going to expect price to be stuck somewhere in between those two bands. And as you're looking at the charts, you might want to, take a quick scan backwards. You'll notice that the vast majority of price has actually been well in between those two bands with a few occasional pops outside. But the vast majority of price is held within. Now, it's important to understand the use of price action as well as other indicators when using these, or when paying attention to these breakouts, because that's what's going to determine whether this breakout becomes a buy for you when breaking above the upper band or a sell. And this is where it's going to get juicy. So now it's time to pay attention. If you haven't been, time to pay attention. When price moves above the upper Bollinger Band, we're given a situation in which we can either consider price to be overbought and expect a reversal to be imminent and look for a selling opportunity, in which case we expect price to be snapped back underneath that upper band, back into the bands, and more adhere to the expectation that 90% of all price movements will be contained within the bands. So we could look for the sell up here. We can look for the sell up here to get in for some expectation that, once again, price is going to be dropping, as we don't expect it to stay outside those bands very long. Now, this is the important part. We don't just want to simply buy or sell because price is above or below. That's not it. There's got to be more to it than that. Bollinger Bands in and of themselves are not directly considered a signal provider for most traders, as most traders use it in addition to other things to help them find a position. Jim says, I wonder if more people trade reversals back inside the bands or if they try to trade the breakouts. Once again, like I just said, it is entirely up to the individual trader, and it depends on what I'm talking about right now, which is going to be price action and other indicators applied to it as well. There's going to be situations in which a break below the Bollinger Bands would be a strong opportunity to sell, as it could be a strong indication of selling momentum that has entered the market with that volatility. In this case, obviously, as the bands have spread apart. But we could have a situation in which selling outside of the bottom Bollinger Band makes plenty of sense. And we could also have a situation in which buying outside of the bottom Bollinger Band makes plenty of sense. Now, how are we going to, on the most basic level, how are we going to help dictate what it is that we're trying to do? How are we going to decide, should I buy or should I sell in the situation now that we have broken outside? Let's go ahead and look at an example. Let's go look at some different examples here and see if I can find. I'm going to see if I can find a very clear-cut example, or at least something close to it. But while I'm looking, guys, what I'm looking for, just to give you guys an idea, those of you that are crafty probably already thought of this, but essentially what I'm going to do is I'm going to show you how price action can be used to verify the validity or the strength of a move. If price has moved above the Bollinger Bands, has moved outside, has broken outside the top Bollinger Band, and as a result, we want to know if we should sell with an expectation of to come back in. But while we're looking at price, we notice that the candlestick patterns are only showing increasing strength, or the power of that buying just looks strong. It doesn't show any weakening signs. The highs are constantly higher. All of those things are great examples of when it would make more sense to buy once we've broken outside that top band than it would make to sell, as there's strong buying momentum taking place and there's no sign of it getting weaker. We don't want to have our eyes glued to these bands and say, okay, just because it's outside that band, it must come back in at some point, so we should hop in for a sell. That can become very, very painful. If we jump in every single time for a sell, it reaches outside the top band, there's going to be some times where it rides outside those top bands with some added momentum, and we could have simply been going with the momentum and taking profit. Jim says, does this work on all time frames as well? I'm guessing yes, absolutely. As we were discussing earlier, the only difference between all time frames and all charts is just simply going to be the measure of the deviations themselves. It's going to be the deviations are measuring volatility. So as a result, as you change time frames, say you're looking more at lunch, or you're maybe looking at the cash open. If you're looking at lunch, you're going to see tighter Bollinger Bands, generally speaking, with lower volatility, whereas if you look towards more the cash open, you're going to be seeing wider Bollinger Bands. But regardless, it is an applicable source of information that we can be used in cahoots with anything else during our daily trading. So yes, applicable to all trading time frames and generally all trading platforms for that matter, but all trading time frames and all assets. It's how you use it and how you interpret the information, obviously, is going to be what makes it valuable or not to you. But let's look at this. This is a beautiful example right here while I was talking. So blink. Oops, I don't want that. I want a rectangle. We're going to focus on this right here. Look at this little setup right here. So what do we have? We have a situation in which the Bollinger Bands were briefly tighter. We ran into a period where the volatility was getting a little weird. During this portion, the volatility started to slow down a little bit. As a result, the band started tightening, and then we started to pick up a little bit of momentum. And as a result, the price was able to break outside the top Bollinger Band, and it's a situation in which we were considering an overbought scenario. It's at this point that our alert sensors have gone off. We say, hey, I remember what Chris told me during that webinar. This is the time that we want to pay attention, because this is the time that we're generally looking to find an entry in or for either a buy or a sell. Now, how do I dictate whether I should be buying or selling here? Well, I'm going to pay attention to how it broke, just like Chris said. So how did it break? Well, looking at this box, we have a candle that broke us through. Here's our initial candle that broke us through. The next candle thereafter, what does it tell us? It did reach higher highs, but we almost pin barred. We have a situation where we have a very long tail, a very long shadow, a very long wick on the top of this candle, essentially nothing on the bottom, indicating a lot of selling pressure holding this candle back. And this is a widely accepted bearish sentiment setup when you look at these three candles in the formation that we have them. Now, if you don't know your standard price action candles, we have quite a few lessons covering standard price action and candlestick patterns that I strongly advise going over. But at this point in time, I'm going to assume that you guys do know your basic Japanese candlestick price action, or have some way of measuring this, whether you're using, say, the MACD or some type of histogram. There's a lot of different ways that you can go ahead and measure the strength of momentum. There's a lot of ways you can measure the strength of a particular move. And however you choose to measure the strength of that particular move, whether you're using the most basic technical analysis known to man and just simply analyzing the Japanese candlestick method, or whether you're, like I said, using a MACD. It doesn't matter what you use as long as you feel comfortable with what you're using and you already understand how to use that tool to help confirm the move that you have now identified because of the Bollinger Band. So in this situation, just using basic price action skills and looking at this three candle setup right here, I would see this as a situation in which I expect price to not last very long outside of this Bollinger Band, as the candle sizes are getting smaller in this situation, and we actually have reversed. And after seeing this long tail on the top of this candle, we have another candle that has gone ahead and closed bearishly, actually just back underneath our band. It's at this situation, because of this bearish sentiment that's being shown by this three candle display after pushing outside of the band, that I would actually be looking to sell in this situation. So I'd be looking to sell. I'd be looking to go down over here. I'd be looking for some opportunity to sell and hopefully ride the market downwards. And in this situation, had I been in for a sell, this would have turned out for a very profitable ride, as the market pretty much plummeted straight down before finding a little bit of support over here. Now, that is an example of when the market looks weak once pushing outside of the bands that a sell would make sense. Now, let me see if I can find an example of when there's strong momentum pushing outside of those bands, in which case I might have wanted to buy outside the top band instead of sell. Now, hopefully the market, as I scroll back here, is going to be very helpful to me and not give me too much difficulty finding this example. All right, here we go. This is one right off the bat. It's not going to be the greatest example, but it is an example nonetheless. Here is our break. So once again, tighter bands. What do you guys know that to be? That means less volatility, but it is still applicable nonetheless. We have a situation in which price has moved outside the upper band, exactly as I was just hoping, right over here. Let's go ahead and use a rectangle tool, outline this box. All right. Jim says I was in the last webinar about volume. I bet this would be a good. I bet this would be good using volume to help filter out some of these breaks. Absolutely. Like I was saying, you can use MACD. There's a number of things that you can use to help solidify your view of the momentum that has recently that you're trying to. Let me think of a more intelligent way to word this. There are multiple ways. There are multiple faculties available to you. There are multiple indicators or techniques available to you. There's no right or wrong answer to it. There's a lot of different ways. That's the beautiful thing about Bollinger Bands, because you're simply just using a secondary or third tool or technique to confirm the strength of momentum. That's all you're doing. So any indicator that you could possibly think of that helps gauge momentum is going to be very useful when trying to gauge a break above or below Bollinger Bands and help get an idea of what to expect thereafter, whether it's going to immediately retrace or go for a temporary ride outside. So yes, volume is another great opportunity to go to use in cahoots with Bollinger Bands, and we did have a nice, wonderful webinar last week on volume. If you didn't, if you missed it, you really missed out. But luckily we have them recorded, so go ahead and get that one under your belt as well if you haven't seen it yet. But in this situation here in the rectangle, guys, we have a situation in which price has worked its way outside the upper Bollinger Band. My poorly drawn rectangle has actually cut off that first breaking candle, but we actually broke out on this big red candle here. This was the first one that worked its way outside. Now, what is this candle? If I zoom us in a little bit more, what I'm going to try to do here, it's going to delete my triangle, and I'll just redraw it. Let's see. Make these a little bit bigger. All right. Go ahead and outline this again. Okay, so we have a situation in which the very first candle breaking outside the Bollinger Bands could be considered a rather strong bullish candle, all things considered. Remember, the word strong in trading is always relative. As we look left, as we look to what price has most recently been doing, a candle of this size working its way upward is a relatively strong candle. That's what I mean when I say that. So we've got a strong bull here in this situation that has broken us outside the bands. Now, what did the next candle thereafter do? The next candle went up, steadily pushed new highs, tried to come down because the sellers jumped in too, had a little bit of a fight. We almost had a weird doji formation, but we still closed off as a bullish candle. We had a little bit of a wick to the bottom side, but the buyers, because we have a wick to the bottom side, that lets us know that sellers attempted to push price down, but buyers stepped in and recovered price. So I like to view this as more of a continuation candle than anything in this situation, and an expectation that whatever happened before is most likely going to be happening again. So if we were working our way up in this situation, we like to view this as a continuation pattern, and what do you know, the price did actually continue in that fashion. Next candle came along, third candle came, and in this situation we continue to push new highs. Sellers continue to fight and lose against the buyers yet again. This is a great example of a situation in which riding outside of the Bollinger Bands, looking for a sell in this situation doesn't make a whole lot of sense. It doesn't make a whole lot of sense to try to sell when we have basic price action skills. If we were to delete the Bollinger Bands, this is the easiest way to think of it, folks. If we were to delete the Bollinger Bands off of our charts here and now and only look at what price was doing in this box, does it look like a good idea to sell right here, where that arrow is pointing, or right here for that matter? Do any of those candles look like good selling candles to you? And if you have any kind of base knowledge of price action, the answer hopefully should be no. As you look to the left, we go this way. I try to draw, I'm going to just try to use this as a straight line. We're not sitting around any relevant recent areas of resistance. We have recently broken outside the bands. Everything at this point is just kind of pointing to bulls. It's kind of pointing to the buyers. It's kind of pointing to price working its way upwards with not a whole lot of resistance going on. So if we were to delete the Bollinger Bands, and you say if you can't decide, and you say, I don't know if I should buy here or if I should sell here, delete the Bollinger Bands or just try to imagine them gone. And does it still make sense to buy or sell? And if your answer at that point is conflicting to what you want to do, chances are we probably should rethink that opportunity before we get ourselves into a mess. And when we look at this these basic candlestick price action techniques, And we see that it looks like volume or the momentum or the strength of this bullish move by the book is only looking like it's getting stronger. It really doesn't make a whole lot of sense for us to start selling there just because the only factor is that we have it outside of the bands. So in this situation, we would actually view it being outside of those bands as a strong bullish trigger, and in turn might want to buy and ride this move up as high as we can. Now, how do we get out of the trade in this situation? I'll cover that now, and we're actually going to go back to the other example or a similar example to the one that I had been talking about, because I realized I didn't talk about how to get out of the position either. But so in this situation, we were looking for a buy because basic price action told us there was strong momentum, there was powerful buying signals being given outside of the Bollinger Band. So we're going to use that being outside of the Bollinger Band as an expectation that price is going to continue outside for a period of time. So we're looking for that buy to possibly scalp a little bit out of the market here. So say we get in. Well, when do we get out? Well, when we get out, in my personal preference, okay, now once again, you're going to try to find your own methodologies. You're going to find what you feel most comfortable with, and that is going to be what works best for you. And what works best for you is obviously what you should use. But what I have found over my years and what works best for me is in this situation that I have entered into a buy on the top side of a Bollinger Band situation like we have here. I am looking to exit the position once price falls and breaks back below the Bollinger Band, which would have been this candle right here. So in this situation, had I gotten in, say, on this continuation candle right here, which already we believe to be, like I said, this little doji we expect to be a continuation candle, had I gotten in with the expectation that price was going to rise in here and out here, whoops, I didn't mean to draw the arrow that way. We're just going to redo that real quick. So here's our box. All right. So say we got in, we got in for our buy. And for a buy here in this green circle, and we got out on the red circle right here. It doesn't take a keen eye to notice that the distance between these two is positive. The deviation between the red circle and between the green circle and the red circle the overall change has been a positive one. It has been a bullish one, and it has been an increase. And in a world where I'm looking to buy, that is exactly what I want, and it would have afforded me or allowed me, because of the rules that I had just put forth, it would have allowed me to get out of the position profitably had I gotten in at this price, just simply by buying outside the bands once I have some type of price action confirming a continuation pattern to be expected, and jumping out of the position once price falls back underneath for a quick little scalp there. So that's an example of how to get in and how to get out during a Bollinger Band breakout to the top side. And earlier, the first example that we talked about was how to sell when price action is showing a weakening out after moving outside of those bands. But let's talk about that once again here. Let me see if I can find another example for you in that situation in which. Okay, this is a nice one. All right. Well, this is a rougher one, but it'll do the trick. It'll do the trick. I'm sure you guys can bear with me here. So what I'd like to focus in on, guys, is right here. All right. All right. So working in on this window right here, this is what we're going to focus in on. So here we have a situation. Jim says it looks like it's about to start raining. I may lose connection. No worries, Jim. Luckily, it is being recorded. Unless I lose connection, we don't have an issue because you'll always be able to rewatch it. So no problem whatsoever. But hopefully you don't lose connection. But anywho, so taking a peek here, guys, we have a situation in which price has moved outside the Bollinger Bands. Now we have 3 long wicks here. We have 3 long wicks in which price has moved outside the Bollinger Bands, but not necessarily closed outside. So that's why I said this is a little bit more of a rough example. But this last candle, this last long wick, it did technically close outside the Bollinger Bands. It depends on how good your eyes are, whether or not you can actually see that. But this candle did actually close outside the Bollinger Bands. But what I want to show you guys is we have an example of price trying to get outside these Bollinger Bands. And it was, because obviously you can see by the wicks, price was outside and broken beyond those Bollinger Bands. for a short period of time over a period of the 3 candles that we have marked off. And these are 15-minute candles, so we're sitting at 45 minutes of activity trying to work its way beyond that, outside those Bollinger Bands. But common price action, once again, using standard Japanese candlestick analysis, shows all 3 of these candles in progressive order here as a bearish setup. Despite price working its way higher, all of these heavy wicks on the top end with really no increase in the highs, and a lot of with shortening wicks on the bottom end and very, very small increases in the candle bodies themselves. This is an indication that there's heavy selling momentum going on right here. And somewhere around that location, the sellers are shutting the market down outside of those Bollinger Bands. In this situation, we actually did have a candle close outside, so it will still apply to my example. So say we notice all of this. We said, hey, we're outside the Bollinger Bands, and we're seeing heavy bearish triggers here at this point. So we're actually going to look for a reversal. We're going to look for a sell instead of a buy. Because in this situation, common price action is not looking good for price to continue going this way. It's looking like it's getting ready to rack, and being outside those Bollinger Bands, it's only a matter of time before we start snapping our way back down. So we're going to try to get in for a sell. Well, not there, we're not. We're going to try to get in for our sell right in this red circle. I'm going to get in for a sell right here. All right, now, when are we going to get out of that sell? Just like we were talking about, this is going to be a simple inverse of what we were talking about before. Just like when we were looking to get out of the sell, get out of our previous position, once price crossed back over those bands again, the same thing is going to apply here. In this situation, because we're selling and we want price to fall, we're going to get out of price. We're going to get out of our position, or I'm looking to get out of my position when price closes, or if price closes back above or shows some type of strength and some type of support. And just basic common sense, basic trading action still applies here. So in this situation, if I were to get into a sell right here and ride price sideways, we have no future breaks until way over here when the market got pretty crazy. Over in this situation over here, the market got pretty wild, started going bananas. But what did we have before that? We had a very nice move downwards. The market seemed to move down slightly sideways, temporarily worked its way up, almost tried to test those Bollinger Bands yet again, crashed heavily. Now, what do we have over here? What did I say about when we want to get out? Either when it gets back above we don't want an arrow there, is what we don't want. We want to look to exit our position either when this situation, when we've gone in for a sell. We want to look to exit the position either when price has crossed back above the Bollinger Bands. I mean, in this situation, we would have been out far before that. Using common sense and standard price action analysis, we can notice that price has come down quite heavily over here. We've gone over, and we have now found a very heavy support. It's at this point that any standard price action trader should be able to identify that price has now stopped. It's not, you don't even have to know much about trading to identify that price has gone ahead and worked its way down quite quickly, and now it is moving sideways. In this little range-bound market, when the price has no longer begun to keep hitting new lows, and we actually start seeing these lows get higher, and then we start setting new highs, it's at this location that common sense would tell us, hey, we might want to exit our position right on over here, somewhere around this location. Anything over here would be a very logical exit point, because it looks like the market is reversing and heading back upwards towards the top of those Bollinger Bands. And because of the increase in volatility, the top of those Bollinger Bands, if we wait to get out at the very top of those Bollinger Bands that have now gotten wider, we could actually end up upside down. If we were to get out over here when we were in over here, we're going to be in a weird situation in which we actually end up with a small loss. Even had we waited, we had no idea what we were doing, we still would end up with, once again, a small loss with the potential for a great gain. So, anywho, let me see if I can find a better example than that one, though. That's a rough one, and I kind of asked you to use your imagination a little bit with me there. But we will, let's see if we can find a better one here. In a perfect world, if we use the example that we had initially used, right here, if we were looking for a sell, like I said, we already talked about this example when we started off. We were looking at, we'll just use white ellipses. When we were looking at this, whoa, that's not right. There we go. Why is it keeps filling and I want white? I don't want fill. White, simply, there we go. All right, in this situation where we have price action telling us that the move outside the Bollinger Band is causing us to expect price to snap back beneath the Bollinger Band. So say we got in for a sell right here to go down, right? We got in for a sell, that's why I did a red arrow. And we were looking to exit either the minute price started showing some type of support and the downward momentum seemed to have stopped, which would have been over here. We would have been looking to exit sometime over here if we were simply looking to get out when momentum has stopped, or if we were waiting for price to close back above the upper Bollinger Band to exit, that would have been over here. And even still, that's still kind of pushing it. It might have actually been this one as well. It's inclined to close directly on it there. Either way, this is a situation in which had we gotten in for a sell by paying attention here, we would have been given multiple opportunities to get out of a very profitable position and almost no way in this situation to really mess this up. The only way we could have messed this up is if we held on to the trade beyond what the charts are currently showing, way on later over here to the right when the price actually was back up there again. But this is an example of when we use price action to identify whether or not we expect the momentum to continue once it has crossed outside those Bollinger Bands and when to get out. I think I've covered both examples there on a move outside the top band, but I haven't really covered much on a move outside the bottom band. Now, it's important to understand that a move outside the bottom band is treated exactly the same as a move outside the top band. The only difference is, obviously, our directional heading might be different. If this move was, let's see here. I'll just find you a fresh example. One second, folks. We're going to find a move outside the bottom band, and that is going to be here we go. This is beautiful right here. Wonderful. All right, so we have a clear move outside the bottom band right here. Clear move outside the bottom band right here. So the initial breaking candle, I don't want to do that. Hold on one second, folks. I'm going to zoom this in a little bit more. All right, there we are. So here's our break outside the bottom band. We have price breaking outside the bottom band, and in this situation, we know, just like I was just talking about when we had a price break outside the bottom band, due to basic Japanese candlestick technical analysis, we have a long wick on the bottom, a very small to non-existent wick on the top, and we have a candle that has essentially closed barely lower than the previous, almost setting us up in a pin bar formation where we're looking to expect price to continue rising after seeing this, regardless of whether we're using Bollinger Bands or not. So when we add that to the price move that has now happened outside the Bollinger Bands, this is a situation in which I'm going to be looking to buy. I want to be buying in this situation. We have moved outside, but price action is telling us that we don't really want to stay going in this direction. And it looks like it's headed for a reversal. So paying attention to this would have given us just about an ace in the hole if we got in for a buy during this applying our price action to the move outside the bottom band, and we would have gone for a very nice ride. And it would have actually been for quite a while here that we wouldn't have been back below. It wouldn't, had we gone by our theory of exiting the position, once in this situation it came back below that band, our entry would have been right here. It would have been right here for a buy. And our exit would have been way over here. And this would have netted a very nice gain. This is huge. The distance between these 2 points, oh, I didn't want that one. The distance between these 2 points is extremely substantial. Extremely substantial. That's an example of Bollinger Bands providing a beautiful ace in the hole. I mean, there would have been just about no way to mess this one up either, and that is simply by paying attention to the Bollinger Bands and then applying a little bit of price action to decide what they're doing outside of those bands, whether they want to stay or not. And basic price action said that's a bullish thing, and because they're outside, we're now going to look for a buy, and up we go, and we're going to go ahead and get out the next time price closes below, and that would have given us a beautiful, beautiful gain. That's an awesome, awesome example. Let me see if I can find an example, though, of a situation in which, oh, actually, there's one right to the left of it, in which selling outside the Bollinger Bands would have made sense due to price action. So here we are, right here. Let's see if I can Jack this up a little bit. All right. So right here, we have a break outside the Bollinger Bands. Now, what does this first candle do outside this break in the Bollinger Bands? This first candle outside the break is a very powerful bearish candle. It has set new lows in relation to the previous. It has almost no wick on the top side. It hasn't even touched any of the previous location. Actually, as a matter of fact, the last 3 candles for that matter have only shown decreasing highs and essentially decreasing lows. The lows are getting lower and the highs are getting lower, which is a standard price action bearish sentiment. In this situation, we'd be looking to sell, and we'd want to get out of the position. We'd want to get out of the position when price finally comes back above and starts trading back inside the Bollinger Bands, which would have happened right here. In this situation, had we gone in for a sell, we would have netted ourselves another positive gain just by paying attention to the Bollinger Bands and applying a little bit of price action with it and jumping back out in this situation. So once again, it is exactly the same as we were talking about with the buys when we move above the Bollinger Bands, just the other way around. It looks like our questions are slow, which is great. I'm taking that as you guys are understanding what I've got going on. If you do have any questions, definitely feel free to ask them. But if not, that's awesome. I hope you guys are understanding and gaining from this. I know I stutter my words from time to time. It is just who I am. I am not always the best public speaker, but I do my best to try to find this to make this the most casual and relaxed learning environment as possible, because I do feel that people soak up the information a little bit better when I do that. But let's see if we can find another wonderful example before we go into a Q&A or either close us off here, if everybody's understanding it quite well. Let's see. Actually, something else I do want to mention that I don't believe I have gone over while we are here on the subject of Bollinger Bands. We talked about that simple moving average that moves through the center of the Bollinger Bands. Well, a lot of times we see that simple moving average. We see price either trading in the bottom half or the top half, not so much directly through the center. And that simple moving average a lot of times can actually be treated as some type of trend line, some type of support or resistance. If you take a look at what happened over here, when price was going ahead and working its way upwards, this was a wonderful area where the market continuously bounced off of it. If we don't even pay attention to the outside of those bands, we were bouncing along on top of this for quite some time, and that could have given us some good insight. And the same thing happens when we're trading underneath it. This is a bullish period in the market when the market was actually trending upwards. And when we look at the market when it's trending downwards with these Bollinger Bands, we go ahead and take a look here. I'm using a straight line to follow a not straight movement, so it's not going to be the prettiest. But in this situation here, we have numerous occasions once passing, we passed through over here on this first mark, but once passing below that center line, even if we didn't care what was going on the bottom side, if we wanted to avoid that because the market seems quite choppy, in this situation it actually was, we can still look to that center simple moving average as an opportunity to expect price to bounce off of it while it stays underneath it. And that's exactly what it did over and over and over again. Every time it approached this area, it started rejecting. So it's important to understand the use of the middle line as well as the outside lines. I heavily talked about trading with the outside lines of the Bollinger Bands when we break out, but it's also very important to understand how useful that middle line can actually be. It is simply a simple moving average, but it has tremendous value. So let's look back a little bit farther here and see if I can find anything else that jumps out at me. And if not, like I said, it's been I feel we've had a quite aggressive, wonderful session here yet again, and hopefully broken some ground with some of you here. Hopefully, some light bulbs turned on at least some way through, and you can understand the value and the importance of using Bollinger Bands in our daily trading along with anything else that helps gauge momentum or price direction. Let's see here. Oh, here we go. This works. This works quite wonderfully. Here we have a very clear break of the Bollinger Bands. Let me see if I can zoom this in for you real quick. All right. So we're going to focus in here on this area right here. So we had a very clear break of the Bollinger Bands at this point in time. And once again, using standard price action. This is the easiest stuff in the book, guys. This is basic trading 101. Basic trading 101, basic price action technical candlestick analysis here tells us that this is a bearish setup. We have a situation in which the highs are having a hard time getting higher, and then all of a sudden we have a very long wick on the top of this candle with a lower low and almost no wick on the bottom end of this body and a bearish close to this candle. This is a reversal formation by the book, and because of this happening right after the breakout side, this is a situation in which I would be looking to actually sell and with expectation that price is going to be moving back below. Now, what do we do? How are we going to get out of this position? Let's pretend like we are in this trade. We've gone in for our sell. We're already in. We got in right here. Say we got in right there when we moved back below those bands. We got in for our sell. Now we're looking for an exit. Now, remember, there's two ways to exit this position. We're either going to exit, and it's whatever one comes first in my book. We're either going to exit when we find some type of support, and it looks like that downward momentum has ceased, or we're going to exit when price has moved back above that upper band. Okay? So let's see what we've got here. Price has moved down. We're traveling downwards. Let's get a white line here. So we're going. And right around this location, we start to run into a weird area of support. At this point, the market has kind of run out of a little bit of the volatility that it had. The bands are starting to get tighter as a result, and we've hit a period where we're now traveling sideways instead of downward. It's at this point, we're noticing this moving sideways, that I would continue to watch it for a little bit of time. It looks like it ran out of steam, and it's at this point that I'm probably looking to exit my position and gather my winnings instead of ride the position too long and get too greedy and end up losing them later on. So it's at this point right here that I'd be looking to exit my position, and because I sold, I'd be getting out with my buy, and that was supposed to be a circle, so we'll ignore that. And I'd be looking to exit the position here for another positive gain with the help of Bollinger Bands and simply applying price action to them. Had I wanted to get out, say I missed this and I didn't, you know, this didn't register in my brain. I didn't realize that price had stopped moving down, even though it's literally just a matter of direction. If I didn't notice that, when would I get out? It might actually not be till, we're going to have to get rid of those. It might not be till over here. So this is the next time that we have a candle pushing and closing outside. It's very, very marginal. It would have been right here that we would have gone ahead and exited. And once again, if you look to the left, that's where we would have gotten in. And if we take a peek, the general consensus is, if we gotten in for our sell, that would have still netted us a positive gain. There is a decrease in price from point A to point B, and that is exactly what we want if we're selling the market. But other than that, folks, it has been a pleasure as always. If you have any questions at all, feel free to ask them. I said that a couple times already. And if no one has any questions, that is fine. Do not feel obligated to ask a question. I take that as a compliment. If you're not asking a question, I feel that the information has sunk in and I've answered your questions before you had to ask them. So you do not have to ask. I'm just trying to be as friendly as possible and let you guys know that while I am here, I do not mind answering any and all questions. Jim says that was very good. Thank you, Chris. Thank you. But it has been a pleasure, guys. This has been another production brought to you by Earn to Trade LLC. As always, my name is Chris. You guys know I love doing these webinars with you and helping you guys grow and become more proficient traders along the way. I take great pride in watching you guys succeed as a result of something I have given you to add to your trading arsenal. I do look forward to seeing you all back here on our next webinar. Which obviously we will have scheduled once again for Monday, unless we notify you guys of anything different. But in the meantime, you guys can keep up with me with my daily recaps where I cover the markets and talk about what's happened and what I expect to come and some areas that are to be on the lookout for. But other than that, guys, get at it. Start practicing with the Bollinger Bands if you are new to them. Practice makes perfect. It is a very important thing to practice Bollinger Bands in all types of situations, just like any other indicator. But it has been a pleasure, guys. Thank you very much for joining me again. Thank you. I will see you all soon. And remember, if you have any questions at all past this point, you can always contact us or possibly schedule a private mentoring session as well. Thank you, everyone. It has been a pleasure. Have a wonderful Monday, folks. I will see you tomorrow.